I'd like to call this meeting to order here, as we could say here. Let me just mention, first of all, that I am not, I was not assigned to be the chair, but I was assigned to be the discussant because Marcello De Cecco sadly had has a very, very serious health problem and could not make it. And the last minute they asked me if I would be the discussant officially, which is what I will be doing. But since there's also no one that is assigned as chair, they asked me to keep tab of the time here. And I'll do that. So let me just very briefly mention what, just maybe I could ask each of the panel, because I mean, I know at least two of them well, but I do not know Adrian. It's not Anthony, by the way.
I'm his brother.
Perhaps just say where they're from and what they do. Just a minute, just so that you'll be able to introduce yourself here. And since we didn't even have a chance to discuss this, and then each has 15 minutes, and we're going to go by the order that we have here, which is alphabetically. I mean, it's alphabetical order here, starting with Adrian. Okay.
Okay.
So, if you want to get started with your, just present yourself first, though. Okay.
Okay. Well, you only have to just press it and it switches the other one off. So I'm Adrian Blundell-Wignall. I'm the work at the OECD here as the director of the Enterprise Financial Enterprise Affairs Directorate, which is one of the big directorates which deals in many things, importantly financial markets, bribery, corruption, competition, corporate governance, lots of issues. So I'm sort of a jack of all trades when it comes to that. But my first love is the financial markets part of it. So that's who I am. Do you want to
maybe introduce ourselves as we go along?
Okay. Yeah, maybe as we go along, it'll be easier. Yeah.
Okay, so we're asked to talk about central banks and distribution. I'm probably going to take a bit of take you on a sort of a bit of a tour of some issues that maybe I'll put up my next one. Between, in terms of what exactly it means, because I've taken this to be very generally, not just any particular country or open market operations or whatever, but rather what central banks are doing between countries is very important today, because the way the world's been organised, especially at the big end of town, is in global value chains, where what happens in any one particular country isn't really mattering as much anymore. You have so people are always pondering, the Fed's got these low interest rates, but nothing seems to be happening on investment. Well, one of the reasons for that is because the world is global now, and you have a very big global value chains where a lot of the manufacturing in the world and so on has been put out into emerging markets, and so for example, an Apple or a Qualcomm, whatever, outsources the manufacturing to a Foxconn, and you get this big global value chain kind of system working. So the way in which central banks affect distribution is, I think, between countries, because what central banks do is very different. And some countries run it in the way that we all like to think of, and others do not. Then between asset owners and wage earners and so on, and a part of this distribution between countries. And then, of course, between present and future generations in terms of ageing populations and the like are going to be some of the areas that I'll touch on. I think we've got 15 minutes, and I'll try and be quick. So how do central banks manage their money? What you see on this chart here, if you look carefully, you'll see a sort of a line graph there, which is going up as it comes out around the sort of the dotted line and the solid line into the Fed's balance sheet, their holdings of Treasury securities and their balance sheet in general. And you can see there that while the Fed's buying a lot of Treasury securities, all the other little coloured parts, they show you what other central banks have been doing in terms of buying US Treasury securities. Now, why are they doing that? Because these central banks, they run their monetary policy by targeting the exchange rate and using capital controls and so on to do it. And the proceeds of that builds up a big pile of foreign exchange reserves, which then get invested into the US Treasury market. Now, how does that influence the story that we're talking about? Well, this is what I mean about a global situation. So you have the situation now where this buying knocked off probably, we've calculated at the OECD, and I think the Fed came up with a similar number, knocked off about 350, 400 basis points off the 10-year Treasury bond yield, and the combination of the Fed plus the foreign central banks are buying. So with zero interest rates in response to the crisis, you have this pushed out through the term structure to be very, very low. Now, at the same time, what other central banks are doing, if you just think about the US versus the these other central banks, who, let me just show you. This is the picture of what the world looks like in terms of GDP, and you'll see there that the United States in the black bars down below, it's kind of like pretty much holding its own in the world economy. Let's call it in 2013 somewhere around 20% of the world, and you'll see there the BRICS and the other emerging countries in the blue at the top and the mid-blue in the middle. And you'll see that their share of the world economy has now moved from, in 1980s, let's call it around 25% of the world economy, 30%, to probably half of the world economy now. And of course, this strategy of financial repression that it's not an insulting term, it's like bottling up savings through capital controls, interest rate ceilings, and all the other things they do to get a big pile of savings, which then get intermediated into investment. And that strategy for development works really well, and you can see really there what's happening. While the US is holding their own, if you look at the pale blue, you'll see that in fact the area of the world which is making room for emerging markets, if I can put it that way, is Europe. Now, this exchange rate targeting, keeping the exchange rate too low, and then putting the proceeds into the Treasury securities along with the crisis levels of interest rates that we have in the West, what does that actually do? Well, the damage to the traded goods sector that comes about through this whole process of 50% of the world targeting against 20% of the world is quite huge. And what does it mean when interest rates go down like that? How does when central banks respond to that pressure, going right back to Greenspan days, how does that work in keeping interest rates lower? Because nobody wants to solve external imbalances by having a recession. So with the global supply shock, inflation staying low, the temptation is to keep interest rates low. And with the damage to the traded goods sector that comes from this approach to policy, what happens is you get low interest rates, which encourages what? It encourages the non-traded goods sector. And in the United States economy, what was the non-traded goods sector? The non-traded goods sector was the housing market and the finance sector. So those two sectors boomed, and then we had a problem. So when we start talking about income distribution, we had a crisis coming out of this process, but it doesn't just come from some idea that the central bank domestically is changing things. It's coming because of a big interaction globally between what central banks are doing. And of course, the crisis and the impact that the crisis had on GDP and on the unemployment and the like is one of the big factors influencing income distribution. And the other thing that happens in this process of what you can see the globalization happening here, and again it comes back to what central banks are doing, what you see happening there is a process of this, the Qualcomm outsourcing to the Foxconn sort of thing, is that employment gets shifted to other parts of the world in this global value chains thing. And of course, when that happens, there's no inflation because of the global supply shock. You have pressure on to keep wages down in manufacturing and other areas in countries like the United States, Europe, and so on. It keeps downward pressure on wages. And of course, when that happens, you get a shift in income distribution, not just between countries, but between the wage earners and the owners of capital, or owners of shares. Because this process, again, I keep coming back to it, the process that really benefits the share market and the globalization factor that's going on here with these two different approaches to running monetary policy, the process there is actually very beneficial to your Apples and your Qualcomms, and of course the cash flow from that is really good. The share market does really well. Interest rates are really low. The share market's going up But those returns accrue to the owners of equities. They don't accrue to the wage earners who are actually struggling with having to sort of the wage pressure that you can be outsourced if you don't. So there's the first major channel of income distribution. I was going to talk a little bit about, I better be careful of the time here, but when you think about the process, who we're outsourcing to, and this is going to take me in a little bit into temporal issues. If you look at who we're outsourcing to, these emerging markets, they run their economies quite differently in another way as well. And here you see, this is based on 10,000 companies, which we've been looking at. You see here in the grey the SOE share of the corporate sector in emerging markets on the right, infrastructure and general industry, and you see the same on the left for advanced countries. And so there's a huge amount of outsourcing is going on to essentially state-owned enterprises, and the inefficiencies that come about with these are quite extraordinary. And so why this relates to intertemporal distribution or income distribution issues, which I'm going to come to right now, is because the value being created in the shares by the lack of investment in the West, combined with over-investment, if you want, or and I use that term for a reason you will see here, over-investment in emerging markets, you see that value creation possibilities are declining. So if you just look at the middle part there, general industry, you'll see it split up between the United States, Europe, Japan and emerging markets. And what it's showing you is the rate of return on equity of the 10,000 companies accumulated up for each of those groupings. You'll see in the general industrial sector, as opposed to infrastructure, you'll see there that other than the United States, which is managing to keep the ROE at a reasonable kind of level, you'll see there in emerging markets that the ROE minus the cost of equity is just continually been moving down since well before the crisis, which implies negative value creation possibilities for listed equities. Now, when you think about what are pension funds and insurance companies investing in, which is the intertemporal income distribution issue, well, you're investing in a world where productivity is not growing in the West. We're not doing the investment in research and technology and innovation and so on, but rather reorganising ourselves into global value chains, which we benefit from in the short run. But in doing so, the basis on which company equities and company bonds and so on in the future are going to be based is a picture that looks not that attractive. Now, when you think about the central banks, why did they ease monetary policy and get them down to zero, other than the way other central banks have come in to buy and sell these currencies to keep the currencies well managed? Well, the initial reason was because of the banking system crisis. And what we do in the OECD is we calculate this distance to default calculation, which is a concept, it's even used in the Basel probability of default and so on calculation. And we do that to monitor, so we've got along the axis here in those different regions, the numbers all represent, each bar represents a bank. And you can see the black triangles down there show you what happened on average in 2008, which is the lower that number, the riskier the bank. And of course, in 2008, and particularly at points during the year, the distance to default, which is the distance you are away from the banks being in a total default situation, was down near zero and or negative. And you can see that if you look at the hollow triangles, you can see in response to these zero rates and other policies that have been put in place, that a year ago things had improved a lot. And the bar now this is very up to date, and the bar now is where those banks are sitting today. So you can see there that in the United States, virtually every significant bank in the United States is well above that line of 3 standard deviations, which means very safe on this measure. Europe, kind of over in the tail, they're looking much better than it did, a couple of years ago. And you can see what's happening. So this policy of zero rates has actually been quite successful. The cost to the taxpayer, of course, which is another income distribution factor, has been really, really high. So they had to pay, for the help that was given to banks. They also had to pay in the recession that followed and the unemployment and so on that happened, which I think will take generations to catch up, if ever. And so the banks now have been really well and truly saved, which you scratch your head wondering, well, why? In that case, don't we have a return to normal interest rate policy? And that's a jolly good question, because we don't. And so with those zero interest rates, and again, coming back to what happens with income distribution, say between owners of assets and those who don't, you see here some of the bubbles that are 4 minutes to go. You'll see some of the bubbles that are being created. I won't talk to those given that. I'll better skip that. I'll come to this graph here, which is on the intertemporal income distribution par excellence. So this is a calculation, pension fund calculation, based on a standard holding of different types of assets. And what it shows you is that for people who worked for 40 years up until the date shown, given the interest rate profile of the period in which they worked, what their post-retirement income looked like. And you can see here that as we moved into the zero rate, the low interest rate, low rate world, this has been continually declining. So there's a precise measure, if you like, of what happens to intertemporal income distribution as interest rates are low. So, for example, if you want to think about that intuitively, if you bought bonds and stocks and things, 20 years ago at very high interest rates, then that was quite good for the people who were retiring back then. They had good income coming from that. But as those things mature and drop out of pension funds and insurance company balance sheets, then you have the situation where they have to be replaced. And at the moment, you'd be replacing them with zero or even negative interest rate things. And again, central banks are well known to be a part of that. I think I'm going to have to skip all of these, given that the time is up. I was going to maybe just come to a couple of points at the end here in terms of... I'm not going to talk to this because you're all looking at anything, my God, he's surely not going to talk to that, and I'm not. But I do want to put it up there just to motivate what's happening. Because in response to the crisis, we had these zero rate policies, but they've been combined with regulatory rules, which have made it very costly and difficult, and have put a high emphasis on institutions, banks, and so on, holding high quality liquid assets, and in particular for the way in which they deal with collateral and margin requirements in derivatives and alternative products and so on. Now, what's happening with these zero rates, and that previous graph I was showing you, the falling income that you get over time in a low rate world, is the pension funds and so on have been responding to that by moving up into, maybe I should have just quickly shown it to you. If you look at the middle graph there, you'll see, even I can't see it from here, but if you look in the middle graph there, you'll see alternative asset allocations for pension funds on the top there. In the grey line, you'll see asset allocations of pension funds. And you see what the big trend has been in pension funds has been through this lowering of interest rate environment to switch into what we call alternative assets. And these are those things that are hedged, that promise you all these things, defying the laws of finance, that we can have higher returns for less volatility, use illiquid products but still have liquidity, that kind of thing. And they've been switching into those, which was why I was going to talk to this graph here. So what's happening in this world of zero rates, which there doesn't seem to be any reason why we shouldn't be getting away from that, given the way the health of the banking system is now looking, and the profits have all returned massively compared to even compared to pre-crisis levels. What's happening is that the demand for high-quality liquid assets is such that, and these new rules is that the people who are on the other side of these alternative products, they are like the cash-poor pension funds and insurance companies. They don't have cash. But they have to meet all these same things if they're going to get into these alternative products. So what's happening is a thing that's called, in the world I move in, called shadow banking, which is where you get broker-dealers sitting between the cash-poor funds who need cash and also have very low returns and have these promises that they have to pay these future generations, which they won't be able to keep because there's zero interest rates. So they're buying these alternative products to try to keep those, which increases their demand for cash, so that they can actually do things like lease out or repo out their illiquid, unlock their illiquid assets, so they can get the cash that they need to manage their collateral in this kind of a zero rate world where the premium is on getting yield. And of course what that's doing is it's shifting the risk, if you like, into the shadow banking sector and away from the traditional insured deposit banking kind of sector. And of course this process, you have to wonder what happens when we do get central banks moving their rates back up again. And so I think if I can sum up, it's not just what central banks are doing in America or somewhere else. It's what central banks are doing in the global situation, in the international financial system, which is having a very big impact through global value chains on employment and on the quality of investment and where it's happening. The zero rate world is pushing pension funds and insurance companies into alternative products because if they don't, the returns that future generations, the promises that have been made won't be able to be kept. And of course this is, at least in my personal view, is just shifting around this bubble that resulted in the previous crisis. And of course it's going to be very difficult to get away from this. So once again, there's going to be future income distribution issues on the line here because of what central banks are doing.
Okay.
Okay, thank you.
Just press the button if you want to. Yeah. No, you just press yours, that switches it off.
Okay, thank you. My name is Gerald Epstein, and I teach economics at the University of Massachusetts Amherst, and I also co-direct the Political Economy Research Institute. I'm going to be talking today about some, there we go. I'm going to be talking today about the political economy of quantitative easing. The focus is going to be on the United States, so I think it's very good that Adrian gave a global perspective to some of these issues, since mine is going to be more nationally focused. And first of all, I want to thank my co-author, Juan Montesino, who's sitting over there, so you can ask him all the tough questions. Much of this work is co-authored with Juan, and I also want to thank INET for financial support of this work. So I'm going to ask the question, what is the impact of quantitative easing on income distribution? I'm going to be focusing on the United States. I'm asking also a related question, and that is, what does an analysis of this impact tell us about the political economy of central banking? And within that context, I'll be using what I call a contested terrain theory of central banking, which most of you probably have not heard of. But it's the argument that central bank policy is really, like all institutions, it's a political struggle. And central bank policy is the outcome of a political struggle between the various important political groupings, classes in society at a moment in time. And one can think of it as, in a very kind of schematic way, as the outcome of a struggle between labor, industrial capital, and financial capital over monetary and financial policy. And I've been doing research for quite a long time on these issues with other co-authors, including Juliet Schor many years ago. And in our research, we've kind of advanced the following hypothesis, that independent central banks are more likely to serve the interests of finance because they are insulated from the political influence of other groups in society, labor and sometimes even industrial capital, and for various reasons, because they closely regulate finance, there's revolving doors between them and finance and so forth. They tend to operate more in the interests of finance than other groups. Milton Friedman made this argument as well. Milton Friedman was opposed to independent central banks. He says, if you have independent central banks, they're going to operate in the interests of the banking industry. Now, quantitative easing is kind of one case study, one window into the political economy of this issue. Why did the government undertake quantitative easing, and what does it tell us about this story? There's another paradox about quantitative easing that I'm going to talk about, and it relates to what Adrian just talked about. So there is this perception, and Adrian spelled it out to some extent, that quantitative easing has worsened inequality by lowering interest rates and raising asset prices. But this goes at odds with the long-standing view held by many, including myself, that tight money, by raising interest rates, helps the rentiers and the wealthy financiers and hurts workers and debtors, who tend to be poor. So how can both of these things be true? How can both tight money and loose money worsen income distribution? How can we reconcile these 2 points of view? Adrian called for raising interest rates as a solution to these problems. The question is, well, will that solve the problem, or will that make the problem worse? How do we understand that? So in this presentation, I'm going to first talk about quantitative easing in the United States and the impact on different sectors in the economy, and figure out what that tells us about the political economy of quantitative easing. And then I'm going to return to this paradox that I just mentioned at the end of the talk. So there are 2 studies that I'm going to report on that Juan and I did. One was on quantitative easing, the first phase, and we're going to look at the impact on bank profits in the United States. And the second paper is a study of 3 phases of quantitative easing and looking at the impact of quantitative easing on the profits of a number of different sectors more broadly. And then we're going to put these 2 together. So the Fed engaged in successive rounds of quantitative easing. QE1 was in 2008. QE2 formally announced the 3rd of November 2010. QE3 formally announced 13th of September 2012. And the Fed ended quantitative easing in 29th of October 2014. The European Central Bank is just beginning its quantitative easing. Now, you've all seen this picture. Adrian showed a global view of this, the mass explosion of the Federal Reserve's balance sheet around 2008 associated with quantitative easing. So here are the questions that these 2 studies address. What was the impact of QE on the profits of banks? What was the impact on the profits of other sectors and the economy? Did these impacts change over time through the successive rounds of QE 1, 2, and 3? Did QE help the broader economy in terms of expanding loans and credit and generating employment? Did it have a broader impact? And why did QE end when it did? So the first study, which I'm going to talk about first, looks at the QE phase, QE1 phase, and looks at profits of banks. And we were able to get data on which large banks in the US served as counterparty banks. When the Federal Reserve went out and bought securities, what are the brokers, what are the banks they bought them from initially? And we compare these broker banks, the so-called treatment group, to a broader range of banks that were holding a lot of the kinds of mortgage-backed securities that the Federal Reserve was buying in quantitative easing. Let me first give you the key results of the 2 papers. Let's see, I think I better go back. In the second paper, we look at the impact on stock prices. So it's a different orientation. The first paper looks at profits. The second looks at stock prices of these broader sectors. So what are the key results? I want to get to this so if I run out of time, you'll at least get the punchline. First of all, quantitative easing first and foremost helped the big banks, at least initially. It also may have helped some other sectors, particularly real estate, automobiles, other big manufacturing sectors initially. But over time, the positive impacts on the other sectors dissipated. So by the third round, only the big banks, more or less, were being helped by quantitative easing. And a lot of the banks were being hurt by it, partly because they were driving down interest rates. And at the margin, banks depend on interest margins to make profits in the short to medium run. So that many banks were being hurt by quantitative easing as well. So in the end, very few sectors were benefiting from quantitative easing. And so there is what we call QE fatigue. By the end, virtually none of the big corporations were supporting quantitative easing, and that's why the Federal Reserve ended it. If you look at the impacts on employment and lending, there was very small impacts, if any, on employment and lending. So it was mostly helped the banks and the big companies. So as I said, we looked at a large panel of bank holding companies. We looked at those that were the counterparties and those other banks that were not, but that held large quantities of these asset-backed securities. We call the counterparty groups the ones that were sold the securities directly to the Fed. The exposure banks were the other banks that held a large quantity of these securities. For example, the exposure banks, if you look at all the banks in our sample, and we just took the top 5% of the distribution in terms of the amount of securities that they were holding, and we called those the exposure banks. So we ran a benchmark empirical model looking at the return on assets, profits over assets, and we have a variable for whether the bank was a counterparty and whether or not the bank was holding a large amount of these securities. And what did we find? We found that there was a large and statistically significant effect on bank profits, very robust. The counterparty treatment, that is the banks that sold directly to the Fed, was roughly twice the median return on assets. The other banks that had a lot of these assets and were able to then sell it at an increased price at the secondary market also benefited, but the impact on them was smaller than the counterparty banks. We then looked at some of the channels that might have affected the profitability of these banks, and in particular we looked at the impact on asset price appreciation. So we found that there was a big capital gains effect from the QE on the assets held by these banks. And so the main channel by which these banks were able to be benefited by QE1 was through asset price appreciation. Did QE1 increase lending in the economy? There have been many studies of this. Most of them, including ours, found no, it did not. We did a bunch of regressions on using the same data that we had with the other study. We found no evidence of increased counterparty bank lending on the economy. So in the first instance, QE seemed to only help these banks and nobody else. So now we looked at QE 1, 2, and 3, looking at a broader set of industries, looking through equity prices. It's a different kind of methodology. It's an event study, so you look whether there was an abnormal equity return to different sectors at the first announcement of these policies. I won't go into the details, but this is what we find. We looked at all this, the companies in the US, looked at their equity prices and looked to see whether there were abnormal returns around the announcement dates of these policies. This is divided into QE1, QE2, QE3. If it's to the right of the vertical line, that means there was a positive abnormal return, meaning that the markets expected these companies to benefit from QE1. If it was to the left of the line, it means that the markets expected these companies to be hurt by QE. And if it's at 0 or around 0, they didn't expect much impact. And this is looking at different industries, all the different industrial sectors in the economy. And basically, if you look at this carefully, you see that in QE1, a lot of companies were expected to benefit in different sectors. By QE2, it was mostly the financial and the real estate companies, plus automobiles and so forth. But I want to draw your attention to QE3. By the third round, there were just as many sectors that were expected to be hurt as to be benefited by QE3. I'll show you some more data in just a minute on this. But you can see why there was this QE fatigue by the third round, that many companies weren't perceived to be benefiting from QE3, and that can help us understand why it was ended. This might give us some information about how we might expect QE to operate in Europe and in other places in terms of its impact on industry. This is just looking at the different sectors in finance, and you can see by QE3 that very few financial sectors seem to be benefiting were seen as being benefiting from QE3. The kind of puzzlingly, insurance is thought to benefit, which you wouldn't necessarily expect, but maybe it's because of the increased risk-taking activities that Adrian was talking about. We also divided it by size, and if you can see by QE3, the only ones above the line are the very large banks and the very small ones who were expected to benefit from QE3. This is the main graph I'd like you to look at. It shows the distribution of expected benefits by firm in the 3 rounds. It shows the mean expected benefit, abnormal return, and the distribution. So you see in the first round, it's very diverse. People didn't really know what to expect would be the impacts. You had a lot of different views of the impacts of QE1. By QE2 and QE3, the distribution was much narrower. People had a closer fix on what they thought would happen. With each successive round, the median positive benefit, the red line, the vertical line, got smaller and smaller and smaller. So this is probably the best picture of QE fatigue. So conclusion, the positive impact of QE, how much time do I have?
We have another, actually 4 minutes.
4 minutes, okay. So I won the lottery here. The positive impact of QE for big banks was reduced over time. The impacts of other firms got smaller and more dispersed. This can help explain the demise of QE, and the employment and credit to the real economy did not seem to be expanded at all by QE. More generally, if you look at the literature on the impacts of QE, it's consistent with some of these results. Most literature says there's little impact on bank lending. There's evidence of a positive effect on QE, on asset prices, on corporate bonds. Adrian shows some graphs on equity prices, but most of the econometric studies are mixed on that, whether QE actually benefited equity prices. But there's certainly been a big increase in some kinds of asset prices as a result of QE. So I want to end with this paradox. Does this mean that if low interest rates lead to more inequality, that the solution is to raise interest rates? Can both loose and tight central bank policy worsen income distribution? I think the answer is yes. Different periods are characterized by different macroeconomic and financial market characteristics. So the impacts of central bank policy really depend on the financial and macro regime. So I don't think the solution to this problem is to raise interest rates. So I disagree with Adrian here on this. So let me go into that, and then I'll come back to that point. In the typical regime that for decades we were used to thinking about, expansionary monetary policy lowers interest rates, increases inflation, generates more employment. So in this regime, this helps workers. They get more jobs. It helps debtors because they get to reduce the value of their debt. And it hurts rentiers and the financial markets. So in the typical regime that we think about, loose monetary policy is equalizing. It takes away from the rich and gives to the poor. And in fact, there's been a lot of research on this, some research that Arjun Jayadev and I did a number of years ago. We looked at the relationship between real interest rates and what we call the rentier share of income. This was in the 1980s and 90s. On the horizontal axis is the real interest rate in various countries. On the vertical axis is rentier share of income in these countries. And you can see that there's a positive relationship. It's dispersed, but there's a positive relationship between real interest rates and the rentier share of income. So higher real interest rates redistribute income to the financial markets and to the rentiers. So what happens in a depression austerity regime, which is what we're in now? A lot of these pro-worker channels of loose monetary policy are blocked. Expansionary central bank policy has little positive effect on inflation for many of the reasons Adrian was talking about, the globalization factor. It has little positive effect on lending and employment generation. Now, the question is why, but it may relate to the business model of these banks, which Adrian has written a lot about. They engage in all kinds of speculative activities with their funds rather than lending to the real economy. In the United States, at least, it has little impact on refinancing of housing debt and debt forgiveness because of all of the blockages, legal and otherwise, that prevents that from happening. So most of the channels that typically lead from loose monetary policy to more egalitarian outcomes are blocked in this situation. So that's one of the reasons why we see the looser monetary policy lending to more inequality. Well, what's the solution? I think the solution is something nobody's talked about yet in many places in the conference, but some places they have, and that's fiscal policy. Central bank policy cannot solve these problems. If you keep pushing and pushing and pushing and lowering interest rates further and further, yes, it will have an equalizing effect, but the solution isn't to raise interest rates. That's just going to push the economy further down. The solution is to have more aggressive expansionary fiscal policy, more public investment, more targeted credit policies by the central bank to homeowners, small businesses, and so forth. And also, let's not forget debt forgiveness in the small and in the large. Thank you very much.
Okay. Where do I push?
He's got to put it up there.
Oh, okay. So I am Dominique Plion. I am an academic from Paris Nord University, not very far from here. And also I am, I can say it, an activist. I'm a member of the network of what we call the appalled economists, les économistes atterrés. That is a group of economists who are very critical about the way politics and political economic policy is implemented in Europe right now. My presentation will be very fairly general. I will insist on the income and wealth distribution of households, so I won't deal as Jerry did with firms, and I will focus also basically on the Eurozone. So my presentation will have four different parts. I will start briefly by what we may call the pre-crisis period, where we can see that the central bank did not take into account, absolutely not, the question of distribution. But we may say that in the aftermath of the financial crisis, the mind of central bankers has been changing, and now they agree that monetary policy has distributional effects. We'll see how far they go now to take into account these effects. I will then talk about the Eurozone, because I think in the Eurozone, compared to other parts of the world, the US, the UK also, we have specific distributional effects. So I will mention some of them. And then I will conclude by asking the question, well, what should central bank do with respect to this question of distribution? Well, starting with the pre-crisis period, we had what we may call the benign neglect on the part of central bank with respect to distribution. As you well know, I think there is an agreement, and OECD studies have been very clear on that, on this topic, that in most advanced economies, we have had an increase in wage and wealth, income and wealth inequality since the 80s. And this corresponds precisely to the period where we had a drastic change in monetary policies. 1979 was the important year in the US and then in Europe in the early 80s, under the influence of the monetarist doxa. Well, monetary policy became very restrictive, and it became also the dominant instrument of macroeconomic policy. And we have here a lot of studies, most of them on the US, by the way, like the one by Koibian and other colleagues in 2012, showing very clearly, using empirical work, that the contractionary shocks by monetary policy in the US during that period had led to greater inequality. So that was the result of a lot of studies in this field. we may say that until recently, most central banks, and in particular the ECB, had a very conservative vision about this question of distribution. Here we have a quote by Benoît Cœuré, who is a member of the board of the ECB. We can see that he says very clearly that the task of the ECB is to ensure price stability in the medium term. So it focuses on income and wealth stabilization rather than allocation of economic resources or on distribution. In other words, distribution is outside the scope of the central bank goals. We can say that the theoretical framework used by central banks, in fact, is such that it cannot deal with the questions of distribution. For instance, we can say that the macroeconomic models used by most central banks in the recent period, with what is called the dynamic stochastic general equilibrium models, the DSGE, in fact have specific features, such as dealing with homogeneous representative households, so no differences between the households. Second, they focus on aggregate measures of income and wealth, so they are not able to take into account distributional effect of monetary policy. Now let's go with the recent period, in the aftermath of the financial crisis. Here we can say that central banker cannot ignore any longer this question of the strong impact of monetary policy, in particular non-conventional monetary policy. In fact, we had three types of effects which have been studied by economists. What we may call the global spillover, which was already mentioned on the emerging market economies. The increase in financial instability, the question of bubbles, which was also already mentioned, and also the third topic, which is rising inequality. In fact, if you look at the literature, in particular the empirical literature, you can see that there is a lot of papers, articles, there are a lot of articles dealing with topics 1 and 2, that is global spillover and financial instability, not as many with respect to this question of distribution, in particular, as we will see in Europe. So here we have another quote showing that central bankers have moved in their mind. They changed a little bit their mind with respect to this question of the impact of monetary policy on distribution. Yves Mersch is a member of also the executive board of the ECB, and there are only 2 years of difference between the two quotes, the one by Benoît Cœuré I mentioned before, and this one. And here we see some change, in the sense that they agree, the central bankers now agree that their policies have an impact on the income and wealth distribution. In particular, non-conventional monetary policy is has a strong impact, in particular large-scale asset purchases, and they recognize that they lead to an increase in income inequality and also wealth inequality to some extent. The problem, as they say, is we agree that it exists, but we don't know how to measure it. So they are kind of skeptical on the importance of this phenomena. It reminds me what happened a few years ago before the crisis, when central bankers would agree that central bank policy can stimulate bubbles, but they would say, since we cannot measure bubbles, we cannot deal with this problem. So here they say, well, we recognize that there is an impact on the income inequality, but since it's very difficult to measure, for us it's difficult to say anything more about it, and then to take it into account this question. There is some interesting, have been recently, so you see a few years ago only, 2 or 3 years ago, some interesting papers dealing with the US basically and with Japan. No interesting papers, according to me, or significant papers dealing with the Eurozone with respect to this question of income and wealth distribution of households. So here I mentioned 3 papers. I won't comment them very much because I don't have much time, but one by Dobbs and his colleagues dealing with household lost due to the decline in interest rates in the UK, the US, and Eurozone. Another by a member of the Federal Reserve Bank of St. Louis, showing that QE has made wealth distribution more unequal. So they agree that there is this problem of increasing inequality. And maybe the most comprehensive paper has come from Saiki and Frost, dealing with Japan. And in fact, this is not surprising, since Japan is a country which has been experiencing the longest history in terms of unconventional monetary policy and quantitative easing. And they show very clearly, using different econometric methods, that clearly quantitative easing in particular has unwanted side effect on inequality in Japan. Now, what about the Eurozone? Well, we can say that in Eurozone we have maybe specific distributional effects. I would start by saying that, and this has been mentioned this morning and this afternoon by different speakers in other sessions, and we will all agree on that the Eurozone is a very special institution in the sense that it is an incomplete monetary and economic union without common fiscal policy. So there is a huge burden put on monetary policy, which is the main stabilization instrument. But studies have been made, and I wrote a paper 1 year ago with a colleague, Robert Gutmann, showing that, in fact, this fact that we have an incomplete monetary union led to the fact that we had an increasing heterogeneity and also increasing imbalances among Eurozone members. So one of the distributional effects we can mention with respect to the monetary policy would be a rising regional inequality between northern and southern countries in Europe, in the sense that you have on one side northern countries with huge current account surplus, which are accumulating foreign assets, external assets, and on the southern part of Europe, countries having important deficits. And we qualify this game or this outcome a winner-take-all, loser-pay-all game, where, in fact, the richest country, the country accumulating assets, has been gaining at the expense of poorer ones. And here you have a diagram which showing the evolution of the accumulation of assets, of external assets by northern countries. So you can see the rising curve, and by debt by the southern countries. By the way, France, for instance, is on the southern countries, and Italy too. And you can see that you have very explosive evolution among European countries, among members of Eurozone, in the sense that you have accumulation of debt on one side and assets on the other side, which is raising a problem. So this is one of the aspects of the European, the way Europe is functioning. In fact, one other idea which is important is that if you compare monetary policy in the Eurozone since the 80s, and more so in the recent years, you can say that monetary policy has been much more restrictive than it has been in UK or in the US. If you take, for instance, the real interest rate level, it's clear that the real interest rate level has been, on the average, higher in the Eurozone than in the rest of the advanced countries like the UK and the US. And one of the consequences of that, according to us, is that the Eurozone has had a lower rate of growth, as you can see, I hope, on the table, than in the US, for instance, if you compare the Eurozone and US. And also, we had a much higher rate of unemployment in the Eurozone compared to the United States. And this is a factor which is very important with respect to this question of distribution. If you look at the channels of monetary policy, in Europe, globally speaking, in the Eurozone, you can say the major channel of monetary policy is the interest rate channel, in the sense that we have also wealth effect in northern part, for instance, of Europe, where the financial wealth of household is very important. But in other parts of Europe, the major channel is the interest rate channel. And here, Mersch, which I just quoted a few minutes ago from the ECB, presented a study showing that we have the positive effects of lower rates in recent years, during the post-crisis years. In fact, it's been dampened for low-income household by the fact that this household has been disproportionately affected by the rise in unemployment. So this is an interesting aspect of the distributional effects of the monetary policy. Another dimension which is very important for Europe, you mentioned this question of intertemporal distribution. Here I would call that the intergenerational inequality, in the sense that in Europe, young workers are much more affected by unemployment, which is the result of fairly restrictive policies. And you can see that in countries like Greece, the level of youth unemployment is 60%, whereas the average is 30%. In Spain, 50% for young people, whereas it is only, if I may say so, 25% for the rest of for the average of the population. And in France and other countries like Italy, it's the same. So here we have what we may call intergenerational inequality, which has been rising, and it is, you mentioned the fact that it is a destruction of human capital, which is really a big problem for European countries. So I will conclude by trying to think in terms of what should central bank do if they accept to respond to distributional issues. One first idea, which has been put forward by Monin last year, is that it would be very interesting and important that central bank report on distributional effects of their policies. In other words, in the yearly report of central banks, it would be interesting that we would have a chapter dealing with this question of distribution effect of monetary policy in terms of income, wealth, households, and also other sectors of the economy, impact on banks, firms, and so on. The other idea, which is that clearly, if we agree that central banks should respond to this question of distribution, then they need to be assigned broader targets than only fighting monetary and financial stability. So they should have targets in terms of employment growth, but also poverty reduction. So remember the quote by Mersch, or even by Curé. I don't think in Europe, and I don't think in the US also, central bankers are ready to take into account this question of poverty reduction, but it should be kept in mind if we agree that central banks should deal with this question of inequality. And then the last idea, which complement what was said by Jerry, is that monetary policy by itself cannot fight or reduce inequality or take care of question of inequality. Clearly, we need to have different instruments and what we may call a system of optimal policy mix, requiring different instruments, monetary, fiscal, prudential instruments, to deal with these different targets, including employment growth and poverty reduction. So this would be the three propositions we could make to have a broader approach by central bank, and including this question of distribution. Thank you.
Okay. I'm going to have to change hat here and be now the discussant. I will focus primarily on the papers that Jerry Epstein and Dominique Plion, because they submitted to me. At least I got them a couple of days ago. But I will also, if you know, wherever possible, mention some what they do. You know, some. Now, just to get to the papers from Montesino and Epstein, I find it an extremely interesting paper on a question which a few in the profession, I think, really understand very well, and you know, you know, the way it's normally proceed, actually, which is to some extent is also a problem in the paper, I would argue, because I mean, they do not spend a lot of time discussing what it was supposed to be doing versus what it actually did do, in a sense. And it would be nice, you know, if there was that kind of discussion a little more, because what is the purpose of QE in the first place? I mean, the way in which I thought it was framed originally, it was supposed to be a kind of pseudo-monetarist approach whereby if you're able to increase the base money at the end, that would lead to automatic, you know, lending and spending, et cetera, et cetera. But it was also, and that's where I think was the credit easing part, which was the idea that it would also impact on especially long-term interest rates here. Okay? So that discussion, I mean, it's sort of missing there, I think, and it would be nice if one had a clearer understanding of that, honestly. But, you know, now, if they were supposed to actually stimulate the economy in some way, now how did they do it? If they didn't do it as in fact Jerry mentioned, which is through bank lending primarily, did it impact on these long-term interest rates to some extent? And what mechanism is there that could have impacted on the economy? See, because one of the things that you do in your analysis is that you have a kind of one equation sort of, you know, regression models, and you're not considering the feedback that it may have had on economic activity in some way. Now, I think you do address it indirectly by saying, look, it didn't impact on lending very much. So in that regard, one could sort of close the loop there. But it would have been good to actually do a kind of almost simultaneity exercise there, where you're attempting to also consider that feedback effect on, you know, through economic activity, if it did have any effect whatsoever. I mean, I'm not suggesting that it did. I don't believe personally it did very much, but indeed, this is what, you know, presumably part of QE was really all about. Hence this sort of simultaneity issue in terms of impacting, let's say, on capacity utilization rates and everything else, lower bank losses, et cetera, would tend to also give you that effect. But now, also you focused on the ratio, the rate of return on assets. Now, again, you don't explain why. I mean, I thought the usual one is rate of return on equity is the one that I've often seen, the rho variable. Now, I don't think it's per se problematic, but it would be useful that you justify why. You know, I didn't get it there. Perhaps I missed it, but I didn't get much discussion on that. And also, what impact is it having, really, is it on the denominator or on the numerator more when you're getting these two? It's a ratio after all. And where is it really impacting on may also give you something about what this quantitative easing is actually doing to some extent. Now, you do mention that it impacts on asset prices, obviously. So obviously, if the major impact on that, that would lead to a reduction in that ratio, you would think, you know. So I'm just saying that it would be interesting if you could perhaps provide some clear links there so that the reader, you know, with, I mean, the denominator, numerator, that kind of stuff is really quite important. Now, that is for certainly very important. Now, also you do go on and try to analyze the effect it has on loans and all that, which I find very interesting because now, without actually questioning whether or not that actually, theoretically, in a sense, would have been a useful exercise. And I say that because based on the principle, which is what we were saying earlier in this kind of pseudo-monetarist view here of QE, which is that it was supposed to have that effect. Now, you do kind of mention yeah, I know. I'm sorry that...
I might just quickly say just one.
I'm sorry. Yeah.
I actually, because the Secretary General changed the council when I have to present to council, I'm a little bit late for it now, so I have to. This was all changed just only hours ago, so I have to leave. So if anyone has any questions or anything like that, I'm happy to take an email or something like that and answer any questions about my presentation. The thing that was a bubble, by the way, shown on my graph wasn't actually equities. It was bonds and emerging market bond price indices. Which was, right. Thank you. Thanks.
Okay. Thank you, Adrian. Now, also another issue which I want to mention with regards to the Epstein-Montesino paper is that one of the variables, I mentioned it because I've done some stuff on that myself, on the rates of return here at banks, where you found that the share of interest interest as a share of income, okay, the banks was not significant, and that, after all, that ratio is the opposite of the ratio of non-interest. I mean, of the non-traditional kind of income flows, where they've specialized more and more. Most of the actual income in the banking sector now, in the case of Canada, over 50% of that is from non-interest activity. They're primarily taking it's like a toll there on transactions tax, if you want to call it that. So it's interesting because that has been, in a sense, a dynamic element of growth of profitability. Okay? And the fact that you're not picking that up is kind of interesting. Now, is it just because the way you specified it? Because I was finding, on the other hand, that it was actually very important, okay, in determining profitability. Okay? But again, I don't have an answer for you, except that I do find that curious. With regards to Dominique Plion's paper, well, yeah, he shows, of course, that income distribution was not traditionally not a concern for central banks. Now, this is because, of course, they see themselves as contributing to price stability, okay? And which gives higher efficiency. I mean, we've been told that in the case of the Bank of Canada, they used to have a whole thing on that they never talk anymore, that somehow it would enhance productivity growth of the economy through a greater efficiency of the system because of price stability, and that somehow everybody would benefit from that, whether it be wage earners or, or profit earners, etc. They would all benefit from that. So this is why they somehow justified not discussing that. Now, Dominique points out that in the aftermath of the financial crisis, central banks can no longer ignore income distribution, and I completely agree. But the question then is, which income distribution should they be concerned about? Okay? And here, I must say that Dominique is kind of very nebulous about all that. Okay? Now, since central banks can primarily impact on, on interest versus, non-interest income, you would think, okay? That they should be, in fact, be concerned about that aspect of income distribution between the rentier, non-rentier sort of sectors, if you wish, but not necessarily vis-a-vis wages and profit relationship, as an example, okay, perhaps. Or at least to clarify that, because you do talk about all of these, but it seems like there's kind of, one is a direct impact. The other ones could be indirectly impacting on it because they do impact on unemployment, economic activity, whatever, and they do therefore lead to effects on wage earners, et cetera, et cetera. Okay? But that's something that I think really needs to be beefed up, because I didn't quite understand that. Now, so you talk about inequality, but as I said, which kind of inequalities are we really dealing with here? Secondly, now, how can central banks affect income inequality here, okay, versus what I would call, wealth inequality, which you also talk about? And for instance, he refers to these, these LSAPs as an important, impacting directly on these sort of income inequalities. But I would have thought that these purchases were primarily impacting on the wealth side, of inequality, if you want. Okay, in fact, that's what you're finding with Jerry's study, to some extent. And I would think, it's something again that one would be interested in understanding. Now, and this is because, of course, if interest rates are falling as they're buying up these securities, they're pushing up asset prices. But interest rates are falling, but interest rates are kind of hitting the lower bound as well. There's this kind of effect there. And therefore, once again, I'm just saying is that kind of distinction would be of some interest to make it a lot clearer. Now, on the Eurozone sort of specific distributional effects, Dominique rightly points out to the deflationary bias of the Eurozone. But is this because of monetary policy or because of fiscal policy? Now obviously, I mean that to me, it's not per se monetary policy any more than in Canada. We don't. It's because governments have their hands tied on the fiscal side that is primarily the problem. One could argue, at least in terms of instruments, that's where the real issue arises, and not because they cannot engage in monetary policy. Just that it's very limited, and indeed the limits of that are such that it's the fiscal policy that is the principal culprit in my case, I would argue, and I'd really emphasize that. Another issue which he also discusses, and I'll end with that, which is the household finance and the interest rate channel. Now, here I think you really need a lot more elaboration on this whole mechanism and how it works. Yeah? And the reason why I think it's a very important one is because, as we know, interest rates remain like relatively low. And what is the real fear of central banks today is the fragility of the household sector. Now, if you're raising interest rates by raising the interest burden on households, how does that impact again? How does that lead to squeezing income distributional kind of parameters in the system in a certain way? Is something which is a big concern by the banks, the central banks, and one would think that it is something that I would again make a lot clearer. Otherwise, thank you. That's it.
Okay. Maybe we should open it up now to questions.
Yeah. Now I'll change my hat again as the chair here. And yes, okay, Robert?
I'm wondering why we don't view central bank that pursue expansionary monetary policy by lowering interest rates or by engaging in QE outright purchases. Why don't we view that as a huge government subsidy for bondholders? In other words, long bond yields fall, a higher price than the market normally would get is being introduced, and an inequality, i.e. bondholder wealth, is being increased directly by central bank expansionary policy. And this is all much more obvious when they do quantitative easing. So why is it that we don't see that as a government handout, as a direct distributional impact? The second question is, have we now entered a theater of the absurd? And I have a blog post on INET yesterday about this, Draghi's doom loops, I'm calling it. As we go to negative nominal interest rates here, we're basically putting banks out of business. They can't have a net interest margin in this environment where yield curves are flattening and where they can't take their deposit rates below zero. And so their net interest margins are getting squeezed. The bank lending channel is getting squeezed out. We may even put insurance companies out of business here because they've guaranteed 5% returns to their customers in life insurance policies, and they can't find an instrument out there to earn that. So have we sort of entered this theater of the absurd as we've gone into negative nominal interest rates and in fact created a situation where there could be a wiping out of a lot of wealth if interest rates were ever to normalize again, and creating a huge policy problem on that side of it as well?
Maybe we could take a number of questions and maybe a few and then bundle them up, Okay, I'll start there and then there's Arturo.
Yeah, thank you for your interesting presentation. I'm Stanislas Jourdan from France, from Basic Income Movement. Recently, there's been a number of voices calling for a more aggressive QE, but in the form of directly injecting cash to the real economy in the form of a quantitative easing for the people, where we basically get the central banks to distribute cash to the citizens. And in a way, this is addressing all the problems we have seen here, that right now the quantitative easing is creating inflation in the financial market, but it's creating deflation in the real economy. And right now in the Eurozone, there's all this debate that the ECB should not engage with these kind of things because it's supposedly forbidden by the treaty, but there's nothing in the treaty that's prohibiting the ECB to actually give money to the people. So isn't there a case for this? And well, I would like you to briefly comment on this, maybe. Thank you.
Mario, in the case of most emerging market countries, the central banks explicitly or implicitly, discreetly or not discreetly, also use exchange rates, and not only interest rates. So there you have a whole set of consequences from the point of view of income distribution. It might be a double-edged sword. You keep a somewhat undervalued exchange rate. It might increase economic activity or whatnot. On the other hand, it might making imports more expensive and exports more expensive, then it might change income distribution. We have the experience of Carlos Diaz Alejandro theory about exchange rate devaluation in the case of countries like Argentina was recessionary rather than expansive, etc. So I would just try to identify that there is not only interest rates and that exchange rate policy, which is mainly handled by central banks, has quite important income distribution effects.
Thank you. It's well taken. Now what I'll do is I'll ask at least the two remaining panelists here to address the questions.
Thanks for your interesting questions. Let me first start with the question about isn't lower interest rates a government handout to the bond markets, the bondholders? And the related question, isn't lower interest rates squeezing interest margins and now hurting the bondholders, or at least hurting the bondholders of banks? I think that's the dilemma there that you captured between the two questions, which is that, yes, certainly under certain circumstances, lowering interest rates, raising bond prices is a handout to people who already hold bonds. But depending on the macro regime, the impacts don't stop there. So the impacts that one normally traces through in that situation is the impact of lower interest rates, perhaps through the exchange rate depreciation, perhaps not, on inflation, perhaps on unexpected inflation. So lower interest rates sometimes, in fact, hurt bondholders. And this was the effect that Keynes was railing against in most of his career. You know, that the Bank of England won't lower interest rates because it hurts the, if they do, it will hurt the bondholders. And so he was saying that the interest rates were held up too high by the Bank of England. So yes, I think in the current environment, I agree with you that lowering interest rates in the United States is a subsidy has been a subsidy to bondholders. But coming the other side is the squeezing of the interest margins, which I think, as our evidence suggested, over time really starts to bite and really starts to hurt financial institutions. And so now there's a real dilemma for the central bank when you have macro policy completely focused on central banking, a dilemma they can't get out of. They cannot solve the problem because they're between this rock and the hard place. I don't know if that answers your question, but and I just want to speak to your question. I think Dominique can probably speak more explicitly about this in the European environment. But I completely agree. I think central bank policy with this kind of dilemma can help if it takes much more targeted approaches to expanding liquidity in the economy. In particular, we could set up a facility, for example, that's partially financed by the central bank, partially financed with treasuries, to buy up debt, homeowner debt, student debt, other kinds of debts, to try to facilitate debt forgiveness, which is to get rid of this debt overhang, for example, that's really keeping the economies from recovering. That's one example, and that's an example of handing out cash, but it's done in a particular channeled way. So I completely agree with you. And Arturo, yes, of course, the exchange rate link is very important. I didn't mention it because the impacts in the U.S. Are probably less important than in other countries, though they're there as well. But I think it's something we have to explore, so for sure.
Yeah, probably, certainly in Europe, in the Eurozone, the exchange rate channel is very important, more so than the US on the average. And we can see what happens now with the decrease, devaluation of depreciation of the euro, which has a very important impact on the European economies, in particular, has distributional effect with respect to firms, exporting firms, non-exporting firms, and so on. So this is a very strong channel of monetary policy. I agree. We did not mention that. I think I mentioned that in my paper, but we don't. It's very important. Now, with respect to the role of monetary policy, you mentioned that it's not clear if it is the responsibility of monetary policy or fiscal policy. You know, the impact on activity, on employment, and also distribution in Europe. What I would like to say is the following, is that if you study the combination of monetary and fiscal policy in the Eurozone since, let's say, the last decades, you can see that most of the time we had what I may call the inconsistent policy mix, in the sense that we had many periods where we would have, for instance, a restrictive monetary policy going along with the stimulating fiscal policy. And recently, this is what we had. We had an accommodating monetary policy by the central bank, while on the average, the fiscal policy in the Eurozone has been restrictive. So there is a problem of incoherence, inconsistency, in fact, here. And this is one of the problems we have. There is no articulation, there is no coordination, what we call policy mix, you know, in Europe, which is a real, very important problem due to the institutional framework of Europe, the way European countries are coordinating themselves or not coordinating themselves. So this is, I think, a very important effect. The other thing I would like to say, for those of you who do not know very well the European countries, we have a huge heterogeneity within the Eurozone, comparing, for instance, northern countries and southern countries. For instance, with respect to financial structures and respect to the financial assets and liability of households, it's quite different if you take household from Netherlands, for instance, from the Netherlands, and household from Greece or Spain. It's quite different. So the channel, the influence of monetary policy is completely different. It's sometimes almost opposite from one side of Europe to the other side of Europe. And this is one of the problems we have to face, in fact. And this is why, for economists, it's very difficult to measure at the macroeconomic level these effects. Okay? And this is why maybe we don't have many conclusive studies with respect to this question of the impact of monetary policy and, more generally, macroeconomic policy on the household behavior or firm behavior. And since we only started a few days ago QE in Europe, of course, we don't have much experience with respect to that, so it's very difficult to know, to determine if it will have the same impact than in the US in terms of bank lending, in terms of rate of growth. We don't know yet. So far, we don't know. And the big unknown is also what will become fiscal policies in the coming years. Will it change? According to most recent studies, it seems to be that the case that the fiscal policy is almost neutral now in terms of the impact on growth. But we don't know if this will be the case next year or the following years. What is the most stimulating dimension of the economy is the exchange rate, and also is a decline in the price of energy and raw materials, okay, which will lead to an small increase in growth in Europe in the coming months. But we have a very, very weak, difficult situation. Thank you. Oh, cash. Yeah. Well, I don't say much about cash or QE for the people, as you mentioned it, because I would agree with Jerry. So I would agree that it could be a solution. And look, for instance, in Greece, for instance, it could be very interesting for the Greek people who want to launch social programs to have that kind of QE. I would agree. But looking at your result with respect to firms, to companies, then I would be more reserved about this idea of having, launching QE. So we should focus maybe the QE on, if it's possible, on sentence, to be more selective on the way the QE is implemented. That would be my answer. In direction of households, yes, but not necessarily in direction of banks or household or firms. Would you agree with that?
Certainly not the banks, yes.
Certainly not.
Small
What about
business,
companies?
well,
small business.
businesses, maybe.
Okay.
Yeah.
Okay, thank you. We have another few minutes here, maybe. Are there any other questions you would like to add before we call? Yes, please.
I would like to entice Gerald to think a little bit more about the second regime that you were talking about. And this regime being different from the regime that we've previously known, right? So you were saying normally when you lower interest rates, it has traction on inflation. These days, it doesn't. But the question why it, or the answer to the question why it doesn't is actually very important. And it's a question that is very difficult to answer, but you offer a remedy nevertheless, right? Because you are saying public investments need to go up and there needs to be more debt forgiveness. So if I may propose to you that there may be two different answers to this question. One is to say, look, the central bank has no traction on inflation. So the government needs to step in, right? And we need to reduce the debt overhang, and it needs to step in with fiscal policy, and it needs to offer more, it needs to encourage more debt forgiveness. That goes, to me, it sounds like in the direction of what secular stagnation proponents are offering. Another one could be, however, that the same monetary policy is basically numbing the incentive for to make private investments, because what loose monetary policy and unconventional monetary policy is doing is inflating asset price bubbles. So there's much more of an incentive for people to go into the financial markets and turn their efforts over there than turning their efforts into making investments that are much more productive in the real economy. So there's a divide between, let's say, financial risk-taking and economic risk-taking. And then if you want to restore or you want to close the gap, you need to actually stop doing what the central banks are doing, raise interest rates, and basically restore the normal economic incentive structure. That calls for a much different policy. And I wanted to invite you to think which way you are leaning, if at all, or if you would agree with that kind of an analysis at all.
I'll just make a quick point on that. The issue is corporate incentive structures are such that they are not encouraged to reinvest profits in tangible, productive capital equipment. It's all about the financial speculation, getting the stock price up. And so corporate management, we basically have killed the loop that we need to get growth. So the reason why corporations are not interest sensitive in their investment spending these days has everything to do with maximizing shareholder value and management having shares. We've broken the growth loop. And the secular stagnation argument that Summers and others tell will not talk about that. They won't talk about that incentive structure. Until you fix that, interest sensitivity is going to be low. And until you wipe out the private debt, interest sensitivity is going to be low, period.
Yeah. Okay, so part of the answer I think Rob just gave, which is that there's been a change in the corporate governance and corporate structure in many economies. Some people talk about financialization, but it doesn't matter particularly what the term is, which does break this link. So the corporations, using Bill Ozonic's language, don't retain and reinvest. They disperse and pay out CEO bonuses. So I don't think raising interest rates is going to change that. It's going to maybe alter their strategies about exactly how they do that, but I don't think it's likely to raise real investment. So another factor is, I think, globalization, what Adrian was saying, has really changed the calculations so that incentives to invest that firms have are much more globally oriented. And so what we're seeing is that there's not that much incentive to invest in the home countries. There's much more in terms of the value chains and so forth. So I just do not see the channels by which raising interest rates under the current global and corporate regime structure is going to lead to more real investment. I don't really see the argument.
Okay, then I guess we could, I thank the speakers here and everyone for participating in this interesting session here. Thank you very much. Okay, bye-bye.